Hello there, welcome to this video. We will discuss a structured product called the participating forward. So let's get going. For starters, a participating forward is a foreign exchange hedging strategy. There is a pre-agreed amount. This is the amount being hedged. It can also be referred to as the notional amount. Obviously, a currency pair is involved. On one side, you have an investor who agrees to sell the base currency or the counter currency to buy the counter currency or the base currency in the pair on a specified date, say the maturity date. The total amount of the currency to be sold, that is the hedged amount, is agreed in advance as mentioned earlier. There is a pre-agreed forward rate, which is also called the strike price, at which the entire hedged amount or a part of the hedged amount will be transacted on the maturity date. There is also a pre-agreed participation rate or proportion or ratio. This ratio comes into play in a particular circumstance. More on this later. If the spot rate on the maturity is worse than the pre-agreed rate from the investor's point of view, the entire amount is transacted at the pre-agreed rate. Therefore, the investor's downside is capped. If the spot rate on maturity is better than the pre-agreed rate from the investor's point of view, only a part of the total amount must be transacted at the pre-existing forward rate, and the balance can be transacted at the spot rate. This part or proportion depends on the participation ratio which is agreed at the outset. For example, the participation ratio could be 50%, 60%, and so on. Therefore, the investor has a capped downside with partial participation in the upside. As evident, the pre-agreed rate is the worst possible rate for the investor under the participating forward contract. He cannot get worse than that, whatever the spot exchange rate on the maturity date. It is as simple as that. Let us take an example to understand this more clearly. Let's say XYZ Limited is a UK-based importer. XYZ needs to pay US $1 million to the exporter after 3 months. The current GBP USD rate is 1.3600. If XYZ buys USD 1 million now, it will have to spend GBP 1 million divided by 1.36, which is equal to GBP 735294. However, XYZ wants to buy US $1 million after 1 month, not now. In such a scenario, XYZ will be exposed to adverse movement in the GBP USD rate. Basically, if GBP depreciates against the US dollar, XYZ will have to spend more GBP to buy the same amount of US dollars. For example, if the GBP USD falls to 1.34, that is, the GBP weakens, XYZ will have to spend GBP 746269, which is about GBP 10975 more than the GBP 735294, which it had to spend at GBP USD 1.36. Of course, if GBP appreciates to 1.40 against the USD, XYZ will have to spend less GBP, that is about GBP 714286, which is GBP 21008 less as compared to the amount that it would have spent had the GBP USD been 1.36. XY wants to limit the worst possible rate for the entire amount, but also wants to benefit from the upside. It has got two objectives. It wants to limit the worst possible rate, that is, it wants to cap its downside, but it also wants to participate in the upside. For achieving this, XYZ cannot enter into a simple forward rate contract because it will simply fix the forward rate for the entire amount, say at 1.3700. XYZ won't be able to benefit from further favorable movement in GBP USD beyond 1.37. Of course, the worst case scenario will be 1.3700. Alternatively, instead of the forward contract, XYZ can buy GBP put USD call for the desired strike price. However, XYZ will have to pay the premium for the option, which is an upfront cost. A participating forward contract can be an option to achieve XYZ's twin objectives. Suppose there is a participating forward contract with the following terms: hedged amount USD 1 million, GBP USD forward rate 1.35, when the spot rate is 1.36. Participation ratio is 60% and the maturity period is 90 days. Note from the terms that if instead of buying the participating forward contract, XYZ simply buys USD at the spot rate of 1.36, it will pay less amount of GBP for buying USD 1 million as compared to the 1.3500 forward rate. However, it will completely forego the benefits of any future favorable movements in the GBP USD, that is, any appreciation of GBP against the USD. This is usually true for participating forwards because the agreed forward rate will always be a bit worse than the existing spot rate. Let's say scenario 1, if the reference GBP USD spot rate on the maturity rate is less than 1.35, in that case, XYZ will be able to buy the entire USD 1 million by paying GBP 741, which is 1 million divided by 1.35, which is the agreed forward rate. Scenario 2, if the reference GBP USD spot rate on maturity is greater than 1.35, say at 1.400, XYZ must buy 60% of the USD 1 million, the hedged amount, which is USD 600,000, at the agreed forward rate of 1.35 by paying GBP 444,444, which is 600,000 divided by 1.35. It can, if it wants, it is not compelled to do so, buy the balance USD 400,000 at the spot rate of 1.40 by paying GBP 285,714. Therefore, XYZ will pay a total of GBP 444,444 plus GBP 285,714, which is GBP 730,158 to get USD 1 million. The average GBP USD exchange rate achieved by XYZ will be 1 million divided by 730,158, which is 1.3696 approximately, which is a decent rate. This can also be calculated by the following formula appearing on the screen. Total amount divided by, this is the whole denominator, total amount into the participation ratio divided by the forward rate plus total amount into 1 minus the participation ratio, which is the balance amount, divided by the spot rate, which comes to 1.3696. Note that in this formula, if the spot rate is below or worse than the forward rate, the participation ratio is 1 or 100%. That is, the entire amount is transacted at the forward rate. If the spot rate on maturity is, say, 1.3000, the average rate can be calculated by the same formula, which comes to 1.35, because this term becomes 0. As evident, the benefits of the participating forwards for the hedger are as follows. XYZ gets a good average rate without paying any premium, without totally foregoing the upside, and it fixed the worst possible exchange rate at a reasonable level. Also, the participating forward is a zero-cost strategy with a limited downside and possibly unlimited gains, restricted in magnitude only by the participation ratio. PFs are customizable, like all structured products, and investors can try to negotiate the terms. Note that this does not mean that the participating forward contract will be the best option in all circumstances for all investors, especially for liquid currency pairs. Arbitrage could make the choice between different contracts difficult. However, one should consider PFs if one does not want to pay the premium or forego the upside potential completely. As evident, the main risk for the investor in a participating forward is the possibility of foregoing the benefits of a favorable exchange rate. Also, the agreed forward rate is always a bit worse than the spot rate at the time of agreement. Regarding the terms, one should look at the participation ratio and the forward rate vis-a-vis the current spot. Obviously, one must analyze the suitability of the product in the current and the expected market scenario at the time of settlement. As we know, basically, if the spot rate at expiry is more favorable than the forward rate, from the investor's point of view, the investor is only required to transact a proportion of the hedged amount based on the participation ratio at the forward rate. The balance can be transacted at the spot rate, leading to participation in the upside. That's it about participating forwards. Thanks for watching and happy learning.